Meta pulling back after a record 20-day win streak. The recent rally could have some investors start calling for the company to split its stock for the first time since going public. You're looking at a 1-month gain here of just about nearly 15%. We want to bring in Ron Josey. He's Citi's senior analyst of internet equity research. Ron, I'm curious how you're looking at the recent record gains that we've seen in Meta and whether or not maybe it could be headed for a split.
Yeah, split, no split. It's you never know what happens there. I would just tell you from the record gains or the continued growth in the stock, and obviously it's pulled off a little bit last few days. It's you don't have to look any further than the results, and also where they're investing, and they're investing in significant hardware, software improvements, given all the opportunities within AI. And frankly, they're one of the few companies where we're seeing these investments turn into revenues. And so when we take a step back and split, no split, just from a fundamental perspective, we're seeing advertisers increasingly allocate more spend to Meta. We're seeing, most importantly, usage and engagement grow. And as long as the usage continues to be strong across whether it be Reels or the feed or stories, or as Meta AI actually gains users, as Threads gains users, all these different platforms, as engagement grows, that creates greater opportunities for advertisers to reach their audience. And I guess at the end of the day, what's driving the move on Meta, and frankly, it's our top pick. It's more advertisers finding more surfaces and being able to really target users and generate that return on ad spend that's needed. And most importantly, not only are we seeing top line growth, but we're also seeing that bottom line hold up pretty well, and that the year of efficiency has continued. We like to say it's a year's or it's still day one on Mark Zuckerberg's year of efficiency.
Interesting, and especially as they're calling it a pivotal year for the metaverse. And so how should we think about all of those elements that you laid out as that relates to what they're prioritizing in this pivotal year for the metaverse?
Yeah, I mean, look, the metaverse, I think, whether it be the metaverse or is it mixed reality or whatever it is, I would just tell you first and foremost, I think they found a hit on these Meta AI glasses with Ray-Ban Meta glasses. And so, frankly, that's driving a lot more adoption of Meta's hardware, which is really interesting. When you take a step back and you think about the broader business, primarily it is core social, it is engagement, and it is monetized via advertising. That's your highest margin that's in the business. And frankly, although they're investing in reality labs in the metaverse, I think margins can actually continue to grow within their core family of apps business, which is their core advertising business, as they invest in these newer opportunities. And so whether it's a year of metaverse or not, I think these Meta Ray-Ban glasses are pretty interesting. Regardless, we're seeing greater usage across all of their products that we think can drive greater profitability overall. And that's what really matters here.
Ron, what about the overall AI trade? The fact that it has lost some momentum. There was initially some concern following the developments out of DeepSeek, very much debated. And I think also widely, maybe there is consensus, obviously, that it could be bullish here in the long run. As you look ahead to NVIDIA, not asking specifically about NVIDIA, but how critical are those results to the overall momentum of the AI trade?
Look, I can't really opine on NVIDIA, but I will say that when you think about what Meta is spending on CapEx, whether between that 60 to 65 billion, what Google or Alphabet is spending upwards of 75 billion, what Amazon is likely doing over 105 billion on CapEx. There is a massive, massive investment cycle going on here, given the opportunities within AI. Now, of course, not all of Amazon's 105 billion are related to AI. They do run a pretty interesting, successful e-commerce business. But point being is, the way we're thinking about the internet today and how we interact with apps could absolutely change. And it could change for the better, in that we could see greater engagement because, these apps, and take Meta AI, for example, these agents become more in tune to what we're looking for. And so it's the race to basically win that engagement. And the investments that we're seeing, I don't think they let up anytime soon. And as we take it back to Meta, with 700 million Meta AI users, on the path to that billion that I think CEO Zuckerberg's been talking about, that creates a wealth of opportunities that's brand new. It's a new surface that Meta's talking about, new potentially search and other things that come down the pike. So we're in the early days of the AI opportunities here.
Ron, just lastly, while we have you, we got to ask about Carvana as well. Shares taking a hit here on the day post earnings, and the company still did see full year sales hit 416,000. That's up 33% compared to a year ago. What is it that investors are not liking about this report?
Yeah, I mean, look, not only was 2024 a great year, they exited 4Q growing their units 50%. They have 17 plus million monthly unique users. They're becoming more profitable with every single sale that's happening here. And so, look, there's a little bit of focus on what they call the gross profit per unit, which was down sequentially in 4Q. But that, in our view, is mostly seasonality. When we take a step back and think about Carvana, look, the growth in units, in our view, continues to be very, very strong. And as they become the leader, or call it one of the top used car dealers in the US, I think they have a wealth of opportunity to not only continue to gain share, but become more profitable. And frankly, I look at the shares down today on potentially, weaker GPUs, which is gross profit per units, which could be seasonal. I look at it as a buying opportunity.
Yeah, if you ask them, they'll say that they are the most profitable public automotive retailer in the U.S. history as measured by adjusted EBITDA margin. Ron, thanks so much for taking the time here with us today. Appreciate it.